Good day, fellow investors. Exxon recently came out with a very interesting announcement, after all other oil majors already did it, of impairments, focusing only on the high quality assets. And this is really a great example of what's going on in the oil industry, what are the likely investment outcomes, and that's what we are going to discuss today by looking at what Exxon and others do. I've been bullish on oil in the last month and in March because I'm looking at the long-term balances between supply and demand, and that's all the game. That's the game when it comes to investing in oil. However, over the long term, I've been negative on Exxon, expecting perhaps not a dividend cut, but not a good situation, and that's exactly what has happened. On the contrary, when you look at the long-term fundamentals, companies like Suncor that we did a video exactly a month ago, Royal Dutch Shale, how they are, let's say, better fundamentally, thus a little bit lower risk. And since those videos, and I have received a lot of good emails from those that have taken action on it, the companies did really well of the complete oil sector. But now we have to see, okay, where we are now, what are the risks of speculating and investing in the oil sector. To make things clear, I'm personally more oriented to natural gas than to oil. I see oil a little bit declining in demand over the long term, EVs and everything that's going on. However, natural gas has more upside, more growth. As those are very related, somewhere in the future there will be an increased discrepancy, and perhaps natural gas gives a higher margin of safety. If you want to check the last report I written on natural gas for November, there is other sector analysis. This is what I do on my research platform, so copper, natural gas, there is a 28-day money-back guarantee, so you can check everything, the stocks I have analyzed, and then you can see whether this is something for you. Natural gas investing strategy, I've written about 60 pages looking at shale, LNG and everything, and then I have derived my investment conclusion there, and I stick to natural gas. However, we've made videos on oil, and the situation is still interesting, and that's the delicate balance I want to explain in this video. The balance between investing, speculating, both low risk, margin of safety, both in oil or in natural gas, whatever you prefer, and the dangers of US shale, all explained in Exxon's discussion. Let's start with Exxon. So Exxon said to prioritize capital investments on high value assets. They are going to focus on Guyana, okay, in the US still the Permian, the lowest cost, exploration in Brazil, and of course chemicals and other things what they do. However, that means capital and exploration investments down about 30% annually. What does that mean? Down, which means less production, which means less supply, which means a higher balance for oil prices. And when a major like Exxon does it, when others do it, which means that oil prices, even if demand is lower, could go higher. And they all try to balance them. They can all produce double what they are now producing in 5 years, but if they would do that, then oil would be at zero or negative, as we would have seen it. So they all try, we have the OPEC meeting now, they all try to balance that, and that's the key also to watch. Further, of course, as we said, focusing on Guyana, Permian, dry gas assets removed from development plan, so less dry gas. Okay, that's again a positive for natural gas because it's all about cost. Impairment, finally they do impairments of 17 to 20 billion, something that they didn't do for a long time. Cost reduction, commitment, reliable dividend remains unchanged. On top of everything, the key of everything is, of course, workforce reduction of 15%. This means a lot of less production, because if they reduce workforce, who's going to work, who's going to explore? Of course, all these assets are going to be sold. They will try to remove less strategic assets from their development plan as a result of growing strength of his portfolio. But all these assets, and this is something to keep in mind for later when we discuss the supply and demand balance, will be bought by somebody else. When oil prices go higher, what will somebody else do? They will put those assets into production, creating oversupply, and then we go all over around those cycles in oil. But that's very interesting and very profitable for those who want to follow that. And then they say monetization of less strategic assets to grow, including North America dry gas assets, contingent on buyer valuations, and they are really removing the Appalachian, Rocky Mountains, Oklahoma, Texas, Louisiana, and Arkansas. So that's very interesting. And then all their assumptions are still on very high oil prices. If I check their assumptions, they still assume the investor day pre-COVID was based on 60 real prices for Brent crude, $3 for gas, and their assumptions are they are sticking to $60 on a little bit less productions, less investments to keep those cash flows stable and the dividends paid out. However, I still think oil at 60 is a little bit too high, and that's something very risky. And if they change the assumptions in the investor day scheduled for March, that might be again a negative hit for Exxon over the long term, because changing from 60 to 50, for example, or 40 like the Russians have, it's a very, very big deal. It's actually everything for long-term fundamentals. But there is still the short-term oil play, which we'll discuss in a second. Also, other companies have lowered investments all over the world, which means less supply, and we have the OPEC meeting now that isn't really going according to plan, but that's always the case with OPEC. They argue, they try to get as much value as they can for themselves, each individual party, so it's a mess. But that's what's going on, and that's something, okay, short term, long term, it's price. Who has the lowest price wins. And the problem with the lowest price is for shale is that it isn't lowest price. We have seen Exxon removing a lot of assets in North America, and if we look at a production of a well, especially a shale, so high initial production, but that declining. And in my report, I have really looked at this, and I have seen when you put this, okay, high production, but the marginal and the really profitable production comes later, and you need to keep the whole infrastructure there to take advantage of this. If you don't constantly grow, and that's the problem with shale, it needs constant growth and investments to take advantage of this marginal long-term production. If you don't grow, you don't build new pipelines, new this, you don't have where to sell this, or if that's a huge difference in flow into those pipelines, it isn't really profitable to remain producing. So I've looked at shale a little bit. The cash flows over the last 10 years have constantly been negative. And people are still not giving up because it's always the short-term bet. Let's start producing. And also, if oil goes up to 60 again, all the assets Exxon sold, somebody will start producing them, and they sold it at 10–20% of what they paid, for example, 10 years ago. But shale producers continue to spill red ink over their finances. It's not profitable, and OPEC knows that, but they know that if they keep it at 49, then these guys are in a bad situation. If they let it go to 70, these guys will start producing, and then it will go again to 20 or even lower. And then on cost, Rosneft increasing production, growing, investing, because if they can produce at low cost, then they have an advantage and they make money whatever happens, and they force the others to cut production. That's the name of the game with oil. Let's put all of this into an oil price perspective. We've seen very low prices in March, oversupply, and then a rebound, and now we are looking at the second rebound, now a little bit declining on OPEC fears, but you can see that it's normal for oil to go to 60, down to 40, 60, down again, and this process will continue, I think, in the long term. For long-term investors, it's really important to nail the long-term average. Exxon and other companies, Shale, as we discussed in the videos, expect 60. I don't think 60 is the right number. Perhaps long-term, look at this balance here. I would say 50. That has huge repercussions on investments on companies, but in the short term, if COVID is solved, if they cut a little bit of production, we can still see 60, which still means 50% upside for even Exxon, or 100 or 200% for the other producers. But if it goes down, if Russia and OPEC decide, let's put a little bit more pressure for 6 months to really kill shale oil producers, then it can go down again, and then the downside is now bigger as stocks already went up, but still a positive trade there. On the long term, natural gas, for example, higher demand, growing demand, even if investments are growing there, but if they cut production of oil, 25% of natural gas production in US is related to oil, coming from oil. If that is reduced, then we'll have also reduced natural gas production, higher natural gas prices globally, and low-cost producers make more money, and that's my long-term investment play, just to make things clear on where am I standing. If this has given you value, please click that like button, check everything I do on my website, my research platform, check it out for 28 days and then see whether it adds value to your investing style. Thanks for watching, I'll see you in the next video.